Good afternoon, everybody, and welcome to today's Libro Credit Union webinar on non-registered investing, building wealth beyond RSPs. We certainly appreciate you taking the time to join us today. My name is Paul McQueen. I am the Vice President of Wealth Management here at Libro Credit Union. On behalf of my 800 plus colleagues at Libro, want to welcome you to today's session. I've also been joined, if you don't mind jumping ahead, by Doug Carroll from Aviso Wealth, tax and estate specialist from Aviso Wealth, and I'll give you a little bit more information on Doug shortly. A little bit about Libro Credit Union. We have over 35 locations in southwestern Ontario, well over 110. I think that's probably closer to 115, 116,000 owners now, well over 800 employees. We are a B Corp. What that means is we are really dedicated to being a company with purpose. It's not just about profit, but it's profit with a purpose. One of those financial pillars that we talk about a lot is financial wellness for our owners. Financial wellness takes on a lot of different ideas around financial literacy, financial confidence, financial knowledge, financial planning. It all fits into that. And today's webinar is a great example of how we might support that, in today's case, in a somewhat specific area. With respect to today's webinar, just a few sort of ground rules and guidelines. We could jump ahead, please. We are obviously recording today's session, but it's a little bit one way. You can see and hear Doug and myself, but we are going to ask that if you don't mind, please participate with any questions you might have in the Q&A section. That should be a fairly obvious link for you in your site. We have found over time that general questions work best. If you have a very specific personal question, we'll still try to word it in a general way, and we may need you to speak to one of our coaches about your specific situation. Everybody's tax reality, everybody's financial reality is just a little bit different, and the nuances matter. So a lot of today's information will be somewhat general in nature, and we will be providing a recording and handout after the event. So as I noted earlier, I am joined today by Doug Carroll. Doug is the tax and estate specialist for Aviso Wealth. Aviso Wealth is the wealth management partner to credit unions across Canada. Some of you on the call may be more familiar with the previous names that our dealers operate under, Credential, be it Credential Asset Management or Credential Securities. But that's all part of Aviso Wealth. Same organization, nice new branding. Doug previously ran an estate planning law practice and was an advanced case consultant with both life insurers and a mutual fund company. Doug holds a business degree and a master's of law specializing in tax, is qualified as a certified financial planner professional, and as a trust and estate practitioner. He's been doing this for over 30 years, supporting our financial advisors, written articles, individual case consultations, and of course, webcasts like the one we're offering today. So without any further input from me, I'm going to turn this portion of the presentation over to Doug.
Okay, great. Thank you very much, Paul. I am going to push up my slides here, and you let me know that I'm actually, where'd you go now? There you are.
Very good. You're good.
Okay. Everything shifts, and not sure whether I actually faded in the way that I need to. Okay, so here's a topic about non-registered investing, and as terminology, it may sound a little bit confusing to, or just not necessarily confusing, but unfamiliar as a term to many people, because it's almost a contra definition, and I'll get into that about the ways that you can invest in registered accounts, meaning that they're registered under the Income Tax Act. And what we're talking about really is stepping beyond the registered retirement savings plan, RRSP type savings, and other types of tax sheltered plans where you either have gotten to the point where you feel that you have sufficient in those places, and therefore you don't want to continue to accumulate there because those types of accounts, although tax sheltered while the money is in there, may be and quite often are taxable on coming out, and you are subject to the rules within them. And so you'd like to continue to invest because you have excess money available, either because you have gotten to the point in your income earning years that you have more to provide as surplus that you don't need to be living on, or perhaps that you've had an inheritance or a gift or sold off something that you own that gives you that much more that becomes investable that you want to invest in a tax informed way. I hesitate to say tax efficient because it's really not um, a consistently defined term. To say tax efficient can mean different things to different people, but definitely you want to be tax informed, that the decisions that you make are driven by the investment criteria that you have, that you and your coach discuss and decide is going to guide you, and then allow for taxes to be part of the discussion, but not driving it. So I've left this up here as the agenda, so you'd have a chance to see where it is that we're going to go with the topics. These are 12 topics that I'm going to get into, and so 12 slides. Basically, I don't think that I have any extra slides that I've included. And I'll just take you through these, and as needed, Paul will step in and hold me up if there's anything that comes up or he wants to comment, as he does from time to time. So I'll just start you into this. And as I said, we're looking at investing beyond RRSPs. That's the subtitle that we have on the topic. And it's not just beyond RRSPs, it's places where you can invest that you don't get automatic tax sheltering because of being within an account that is registered under the Income Tax Act. And these are the common types of accounts that you'd be familiar with. RRSPs, which are by their name for retirement savings, and then below that, registered retirement income funds, that if you've accumulated in an RRSP, then on the drawdown point in your life, you'll convert a large portion of that over into a RIF. Possibly you'll cash out some right away, but otherwise continue to do the investing decisions that you want to make with that money as you move over into a RIF account that has a minimum required drawdown from it, as opposed to an RSP that is an accumulating type of vehicle. And then a couple of the activity specific or places in life specific types of plans, the RESP for education savings, RDSP where there is someone, either yourself or someone within the family, that has a disability. Those types of plans do allow for tax sheltering. The money that goes into them, you don't get a tax deduction like you do with retirement savings, but you do get tax sheltering on those plans, and there's significant government contributions that can happen with those plans. The TFSA is a very broad general savings, flexible type of plan, and the First Home Savings Account was introduced. Well, we first heard about the possibility a few years ago in the election campaign, the most recent election campaign, and then it was introduced in 2022 as something that was going to be available. And as of last year, it is available for people who are first home savings who are in that position. So what we're talking about then for the rest of this is really about non-registered investments. And sometimes the phrasing that's also used is an open account, a taxable account, a cash account, those types of phrases. I wouldn't say that they're exactly synonymous, but when you hear those phrases, it's usually referring to this type of non-registered investment account. So when we're investing generally, to lay the groundwork on things, there's four principles of tax planning. Whether you're an individual in your own household or you're a multinational corporation, it'll be one or more of these four pillars that you will be applying in order to be more tax effective in your life. And I've used the phrasing here: defer, prefer, shelter, and splitter, just so I could have the ER at the end. They don't all rhyme, but at least they've got that consistency about them. And as you see here, the benefits you get from each, and you can have more than one applying in a given circumstance. The benefits you have is when you defer, you're going to pay the tax later. So that's ideally what you don't want to use your current dollars to pay the tax. All else being equal, if you can pay at a later point in time, then time value value of money, it's going to cost you less to pay later on due to inflation happening. That if you have to pay with next year's dollars or dollars a decade from now, that's going to be less costly to you than paying upfront right away. Sheltering is simply that when income is earned within an investment, whether it's the account type or the type of holding that you have that is not causing you to be taxed on a current basis, then you have buildup of value, but without paying the tax on that buildup. So that's something which can keep more of your dollars invested and allow you to accumulate more, knowing that at some point you will have to pay the tax, but in the meanwhile, you've got as many of those dollars working for you as you can. Preferred taxation is something that we'll get into, particularly with the non-registered investments, because it's referring to the type of income that you earn being accorded a lower or preferential lower tax rate or preferential tax treatment. And the last item here is the first three are about the investments or the investment accounts that you might have. And the last one about splitting is that ideally is perhaps not the word, but potentially, because we have a tax system that is called a graduated bracket system or a progressive tax system where you pay higher rates of tax on higher levels of income, if you can share the income for a given household in a legitimate way among the people who are there, and particularly with spouses, then rather than one person at the extreme earning all of the income and pushing up through multiple bracket levels and paying higher taxes at the higher levels, then if you can have two people who are earning the income and each in the perfect way that it might operate, each were earning 50%, then you're not going to push up into those higher brackets. So splitting is something that you generally try to do for reduction of the tax cost in a house. And then just to give an example of how this would work, this is going back over to the registered accounts and specifically with RRSPs, registered retirement savings plans. It has elements of all of these things in an RRSP, in that you get an initial deduction of income that you earn in a year. Because you put it into an RRSP, you're not taxed on that income as received because you put it over into the RRSP and you get your deduction, which then allows for that money inside of the RRSP to get its tax sheltering. It doesn't get taxed while inside. Then when you draw the money out and take it into your hands later on, you have at least some part of it preferential tax treatment on the first $2,000 of drawdown off of RSP sourced income. It would have to be converted over into a RIF or an annuity payment. The first $2,000, you get a tax credit on that. So it's preferred tax to that extent with that portion of it. And you also have the possibility of doing splitting, either by contributing into a spousal RSP instead of your own, with the assumption that your spouse is expected to be a lower tax bracket than you out there in the future. And if you have not done that, and even if you have done some of that, you also have the pension income splitting rules where you are in a spousal relationship, whether you are married or in common law, up to 50% of the income that you receive from RSP that becomes RIF money or registered pension plan money, up to 50% in a year that you receive can be split over to the other. So there's all four of these concepts, these pillars, can be applied in some types of investment accounts. In other cases, it might be one, two, or three of them that might apply. But there's your basis for tax planning overall, is trying to make use of these four pillars when you try to do your tax planning. When we talk about the type of investment that you are earning in non-registered accounts, it really does matter what the type of income is. Inside of RSPs, I'll keep referring back as comparative to RSPs. In RSPs, the type of income that you earn is not relevant inside of the account from a tax perspective. It certainly matters in terms of the investment choices that you're making and how much risk you might be taking on out in the markets. But from a tax perspective, it doesn't matter whether you have interest that you earn, or it's a dividend, or it's a capital gain or an otherwise capital gain inside of an RSP. All of those things are increasing the value of what it is that you're holding. And when you draw the money out, all of those items on coming out are taxable. They're just all added to your income in the year that you draw them out. But with non-registered accounts, it really does matter what type of income you have. So when we distinguish types of income, we start on the basis of what's called regular income. And regular income includes your employment income, your salaried income that you might have, as well as those amounts that you draw from an RSP or RIF, all of which are fully taxable. So they're completely added to your tally of income in a year. But then when we talk about non-registered investment income, we want to distinguish among the types of income that you can earn. Interest and foreign dividends. So foreign dividends being, not to treat everyone as not being knowledgeable at all, but we do have to distinguish between foreign dividends and Canadian dividends. Where you own a stock or where you own a fund, a mutual fund that in turn owns a stock that stock in a company outside the Canadian borders, when a distribution is made from that company, that is a foreign dividend. And because it comes from a foreign company, it doesn't get any special tax treatment here in Canada. Interest and foreign dividends are fully taxable in the year when they're paid. With capital gains, and I'm going to get deeper into capital gains and Canadian dividends in just a moment, but I wanted to have them side by side to start with here. With capital gains, you get two really helpful things that are going on with them. I should actually add a second line in here, in that while a holding that you have is increasing in value, or for that matter, if the price of it goes down, it doesn't affect you while you are holding on to that. It's only when you sell it off, or some portion of it off, which is referred to as a disposition, that then you trigger the tax treatment of that particular holding. So if it has grown in value, you have a capital gain, and only half of capital gains are taxable. Hold on to that thought. And I know Paul is probably going to step in shortly. With the announcements in the most recent federal budget, there are some potential changes, depending on who you are and your income level, to how capital gains may be treated. And then the last type of income to touch on here is looking at Canadian dividends, again, distinguishing from those foreign dividends. A Canadian corporation, which is a Canadian taxpayer, pays its taxes to the Canadian government, or the combination of the provincial and the federal government, and then it can then pay out the dividends to its shareholders. And you, as a Canadian resident, likewise, will then pay tax on that dividend payment from the Canadian corporation. But there is a coordination of the fact that you have the source of that money being from a Canadian corporation that gets you a preferred tax rate. And there's a two-step process involved with that, which I'll go into shortly. All right, so just to give you a reference point of the treatment of levels of income, this is not the full picture. This is the cross Canada top bracket rate that applies on the respective types of income: regular income, capital gains, and then Canadian dividends, whether that's what we refer to as eligible and ineligible, and I'll talk about the distinction between those. But again, those two on the right hand side are referring to Canadian dividends. You can see what the top bracket rates are for all of those things, and capital gains, as you see, is the most preferred type of income that you're going to receive. Understanding, mind you, that in order to get a capital gain, you've held on to an investment that has appreciated in value, and quite often you'll hold on to it for a fairly significant amount of time. And so you are subject to the changes in the market forces that might allow for that to increase in value, but it also can be not a straight line ride. So that's something that in terms of your personality, your comfort level with the variability of investments, is something to be aware of when you are pursuing capital gains. You do get the preferred tax treatment, but you do have to maintain a fairly long-term perspective to be able to hold on for realizing on that type of a return on your investments. So, as I said, I want to give you the distinction between the treatment of Canadian dividends and foreign dividends. So here we've got the foreign corporation, the smokestack. I wish I could find a different image for that, but in terms of something that's easily identifiable, it seems to be that you get these factories that are happening. Anyhow, there's our smokestack and our foreign government with the flag on top of it, that the foreign corporation is required to pay its corporate tax over to that organization. And basically what a dividend is, once a corporation pays its taxes to its overseeing jurisdiction, then the net after-tax amount that it has is its available earnings that it can reinvest into its business if it wishes, or it can distribute out some or all of that to the owners of that business corporation, and that's what a dividend is. It's the payment of some part of the net after-tax income of the corporation. So when you receive that as a Canadian investor, you get an income amount from that foreign corporation. And as far as Canada is concerned, that foreign corporation has had no interaction with Canada, and so there's no reason to treat it as anything other than an income amount to you as the Canadian resident investor. Comparatively, when a Canadian corporation pays tax over to the Canadian government, or the combination, then the dividends that are paid to you have already been tagged with some Canadian taxes. And as a revenue principle and a policy, the Canadian government will want to collect a certain amount of tax revenue off of income that is generated within its or our borders. Because the Canadian corporation has already paid tax on its income, then when the dividend is paid to you, you get credit literally get credit for the fact that some taxes have already been paid to Canada from the income that was generated. So what happens is there's a two-step process, and it's called, I'm not going to go through the arithmetic, but it's called the gross up and then the tax credit. What the gross up does is, on the dividend that you receive, it's converted into a higher amount as if you earned the income that the corporation earned, and then you calculate your taxes of what you will owe based on you receiving that income. Then the second step of the process is that you then get credit for what the Canadian corporation already paid. So you're paying the difference. In terms of the total revenue that the government is trying to collect, you're not going to pay the full bore that you will pay with the foreign dividend. You are going to pay the difference between what the corporation already paid to Canada and then, therefore, what you are responsible. And between the two of you, the Canadian corporation, you a Canadian resident shareholder, the government will have collected its total revenue, but from two different taxpayers. So when you receive a dividend from a Canadian corporation, then just back to the main issue, you do get a lower tax rate on that dividend in comparison to a foreign dividend. Now, capital gains, as I mentioned, this is something which has been the subject for quite a long time of potential changes that we might have been seeing. It's been dreaded perhaps, or been a concern for years or even decades, because the last time we had a change to the income inclusion. So right now, right at this second, and certainly prior to the budget that happened last week, half of capital gains were taxable, and that's still maybe the case, and is the case for a lot of investors, a lot of Canadian taxpayers, for much of the capital gains that they may realize. The last time that we had a change to the inclusion rather than being half taxable was back in the year 2000 or 1999 or 2000, when the inclusion rate, the amount of the capital gain, was higher. And as announced last week, we are now looking at the increase, or an increase, to how much of a capital gain will be taxable, depending again on your income level. So just on the base level rules, though, you get two aspects to capital gains that work to your benefit. You don't pay tax on the change in value. As I mentioned earlier, the price rises as long as you have not sold off anything. You're not taxed on that. But then when you do pay that, you do have a sale, a disposition, then you do realize a capital gain, and you'll be taxable on that capital gain. Hey, Paul, am I still on? Because my sound just beat just a second ago.
Well, I'm still hearing you fine, Doug. No problem at
Okay.
all.
Okay.
I will jump in here just if you don't mind, because I know that this
Yeah.
has been a recent question, obviously with the federal budget and the change in increasing the amount of the capital gain that will be included above the $250,000 threshold. And we've had a few
Yeah.
questions from our owners and investors about that. General initial reaction from our team has been, listen, if you weren't talking about generating gains or losses previously, I don't know if this should be enough to make that change of decision. However, if there was something major in your life that you were considering this year, an example might be selling a cottage, then that date might be material to your decision and the timing of the decision. Anything you would add to that
Yeah.
general advice at this time?
Yeah, and I don't want to be seen as downplaying the effect that this will have on small business owners, if that makes sense, large small business owners who have had large accumulation in their business ownership and may now be facing a larger capital gains treatment on the eventual sale of their businesses. That is something that those people should be speaking with their accountant about, to see how they might readjust their expectations, and perhaps make some plans of how they're going to manage with that. But on a non-registered portfolio, as you said, Paul, the threshold that's been given is that you still get it in a year. You still get a tax treatment of 1/2 of the capital gain being taxable, up to $250,000 in a year. And that's not just this year, that's each year, assuming that this passes into law as is, then that will continue to be the case. That's a pretty substantial capital gain on an investment portfolio. So if you're not in that position already, that you've got very large capital gains beyond 250 that you expect would happen in a single year, then this shouldn't change your approach to your investment decisions all that much, if at all. But where you have a large single transaction in front of you, then June 25th is the date when we go past, and the between now and then, June 25th this year, between now and then, half of capital gains are taxable. After June 25th, then for this year as a transitional year, that $250,000 threshold will apply from that date through to the end of this calendar year. So as you say, if you've got a pending sale of a cottage where you bought for a pittance, and it's going to be a really hefty capital gain that you might be facing, then if it happens before the end of, before June 25th, then you'll be right in with the half treatment. As you get past that date, though, then you might be having at least some of that capital gain caught by that 2/3 amount. So not to tell people to make their decision based on taxes, but it's a pretty big factor now for people who are in that position. So it's important to have a conversation with your accountant.
Yeah, thank you, Doug. No, it's great. And I just want to encourage anyone on the call who has a question or comment to please make sure that you add that into the Q&A section. We do have a couple questions that were submitted in advance, so don't worry. We'll have some things to keep Doug on his toes later in the call. But if there's anything specific resonating with you, by all means, please feel free to add it in. Doug, back to you. Thanks.
Okay, so just picking it up from I'm about 3 bullets down there in the sub bullet where it says proportionate return of capital. When you sell off an investment that triggers a capital gain, your own money that you put in is your capital, and so you get a return of that capital non-taxable. It's the gain which is subject to the tax treatment. I'm not going to go through all the different variations on it again. It's the gain which is subject to the tax treatment, and so the net cash that you have in hand sometimes surprises people because the suggestion of there being a taxable event makes it feel like, oh my gosh, this as a gross amount is open to or subject to tax. But in fact, the return of capital portion, which is quite often a substantial part of it, is not taxable. It's the gain which is subject to the taxation. Now, on the downside of things, if you have an investment that has fallen in value, then that's a capital loss. And unfortunate as that may be, it could be that you've got some type of holding which has gotten to the point where you've decided that it's not going to recover from where it is. There's going to be a loss on it. You don't want to continue to hold it for a longer period of time. And so one of the things that that you can look at is what's called tax loss harvesting. Because when you have a loss in a capital loss, when you have a capital loss in a year, capital losses can be used to offset capital gains in that year. That's the first place where they must be applied, so that you will have between the two of those transactions, doesn't have to be just two, but the combination of all the capital transactions you have, you would have a net gain position as opposed to a capital gain unto itself. And so that's applied in the year when a capital loss arises. It's applied against the capital gains in that year. And then you have a choice. You can then take any remaining loss. If you've offset all of the capital gains occurring that year, you can take all the remaining loss and you can carry it back to offset past capital gains up to 3 years ago. So any of the 3 preceding taxation years, you can carry back and refile your taxes for those years to reduce down capital gains that you received in those years. Or, and you don't have to do only carrying back, but you can do that. And if you don't want to use it against those, you can carry forward indefinitely the capital loss to be used against future gains. But usually, if you have capital gains in the past 3 years, you'll want to apply that against the gains that you've had. You already paid tax on it, and you get to recover tax, as in cash, on refiling the taxes from the past, whereas the future is still somewhat uncertain. So carrying forward is going to be usually your next decision after carrying back and trying to recover some of the tax by refiling. If you are doing any kind of a sell-off of investments that have capital losses, you may very well look at the particular investments that you have and say, oh, this is something which I still believe in as an investment principle, that this is a good choice that I've made, and I expect that this particular holding, this particular security or fund will increase in value. It makes sense, but it's down right now. I'm going to nonetheless decide that I'm going to sell it off so that I can realize on the capital losses to use against capital gains. But I still want to hold on to it, or I want to be around for its recovery, its increase in value that I expect. Again, not guaranteed. The concern that you will have to be careful about is if you reacquire the exact same security within 30 days, either before or after the transaction that leads to the loss, then you face what's called the superficial loss rules, and it's kind of a constraint on how you deal with your triggering of capital losses, that the loss that you thought you were going to use against the capital gains, whether that's this year's or again preceding a few years, the loss that you thought you had, if you have that transaction within that window plus or minus 30 days, the loss is denied for usage on a current basis. And instead, the reacquisition, the other transaction that you had to get back into this thing, the reacquisition, it effectively puts the holding that you have at a it adjusts the adjusted cost base. That's the adjustment of the new holding, so that eventually you can use that loss, but you just can't use it now. So make sure that before you undertake this, have a conversation with your coach who's going to be assisting you if you're doing this, so that you don't run in afoul of these rules, and that your intention to harvest out any losses will in fact do that and not put you in a position where you're put right back to where you started from if you act too quickly within that plus or minus window. Now, one of the things that that is for those of you who are a little bit more arithmetically oriented, let's say, is to do a comparison with the types of income that you can earn, which have the preferred treatment, specifically the capital gains and the Canadian dividends. Oh, Paul, remind me, I have to give a clear explanation of the two types of Canadian dividends. But in terms of your investment portfolio, unless you want me to do that now, in terms of your investment portfolio, you're going to have preferred tax treatment if you have capital gains or Canadian dividends. You could look at the percentage rate that applies to those and say, oh, I'm going to be taxed at 24% on the, well, let's look at Ontario, 27% on the capital gains versus 54% on the interest, or I might be at 39% on Canadian dividends. And there is a formula that you're seeing here, which gives you a way of comparing the interest rate equivalent or interest rate equivalency of earning the preferred type of income versus earning the interest as that type of income. And it's 1 minus your marginal tax rate on interest divided by 1 minus your marginal tax rate on the particular type of preferred income. So I use Alberta here because it's alphabetically at the top of the line. You see the two figures that I've highlighted, the 0.68 and the 0.79. Essentially what this does is it says, if you were going to earn $1 of interest, how much would you have as spendable money at the end of the receipt of that? And in this case, at 48% for Alberta, you'd end up with 52 cents. So then how much would you earn of either of the preferred types of income less than a full dollar in order to be in the same spendable cash position? So with capital gains, it's 68 cents, and with the Canadian dividend, it's 79 cents, because the tax rates that apply to those are preferred. And in all of these cases, you end up with 52 cents spendable. So it's a way that you can do a side-by-side comparison of the types of income that you might be earning. It shouldn't be seen as a tool that sits entirely on its own. It's just a way to consider how it is that you earn the income that you have. Interest income, depending on how you earn it, if you earn it off of a GIC, a guaranteed interest certificate, then there is a lock-in guarantee of the amount that you're going to receive. You know what you're going to get, but having locked in for some period of time, you can't use those particular dollars to go out into the market to invest and potentially earn other types of income, and nonetheless be subject to variability that might happen out there in the markets. So you have trade-offs that are happening, whether you are earning interest income, which is in the case of a GIC guaranteed, interest income that might come off of bonds, which again, the interest payment might be a fixed amount that's going to come from the bond, but the bond value might change. And so while you're holding on to it, there's a combination of the types of return that you're going to get off of that. And you compare those to potentially what you might get on capital gains and Canadian dividends. It gives you a way of doing a side-by-side comparison. One of the things that that comes up here, actually, I'm going to stop here, Paul, because I do want to clarify the. I adverted to it earlier about Canadian dividends, and I want to clarify. As you saw earlier, I'm just going to stay on the screen here, but I'm just talking about the Canadian dividends here. As you saw earlier, I had two columns showing in terms of the total dollars. There was what's called eligible dividends and ineligible dividends, and that can be really confusing. You say, well, I want to get one or the other. The type of dividend you get off your investment portfolio is almost always going to be what are called eligible dividends. And essentially the difference between the eligible and the ineligible dividends is where the corporation that pays you the dividend has paid full general corporate rate tax to the Canadian government, then you get the kind of tax credit that is very, very high, because the corporation has already paid high tax rates to the government. If you have your own corporation, you pay a small business tax rate at the corporate level, and that's really great to help run your business. But then when you pay a dividend out of that corporation, you don't get the so-called eligible tax credit associated with it. You get what we refer to as the ineligible tax credit. Between you and your corporation, you still pay the same revenue amount to the government. It's just that your corporation pays a lesser amount, you pay a higher proportionate amount on receiving the dividend out to yourself personally. I probably just confused things rather than clarify, but because I referred to it earlier, the distinction between the two types of dividends, I just wanted to touch on that before I move on to talk about foreign dividends. In your portfolio, it would be Canadian eligible dividends that you receive. So on foreign now, we already talked about the tax treatment of foreign dividends being taxable and that you don't get a tax credit on them. And then it sometimes appears that not only are you being taxed by those foreign sources, but you're getting double whammied by it because there might be foreign withholding tax. The thing to understand about foreign withholding tax is that it's not an additional tax. What it is what the foreign government is requiring that the payor of the amounts, in this case a dividend that might be paid to you from a foreign corporation, again directly holding that security or within a mutual fund as a two-stage process, the foreign government has, based on tax treaties around the world, the source of the income, source country, has first right to lay its tax on that income, and then the resident country, that's you as the recipient, you being the person who receives the dividend, your jurisdiction then has the opportunity to tax on you receiving it. So there's two places that are happening. The foreign withholding tax is simply that foreign government saying, we're going to hold back, or we're going to require that a certain amount is held back by the payor before paying the amounts out to you. And commonly, if there's a treaty between Canada and the other jurisdiction, commonly that's 15%. So you'll get 85 cents instead of $1. The quid pro quo on that is that when you file your Canadian taxes, you generally will get a foreign tax credit equal to what it is that the withholding tax amount was. So you're not, in almost most cases, you're not going to pay any more tax. It's just that it's divided between the foreign government, its collection, and what you are going to pay to Canada. With registered accounts, RRSPs, I'll just use that as the main example. With registered accounts, the unfortunate thing is that those foreign tax credits, because the registered account is non-taxable, it's tax sheltered while it's growing, that foreign or that withheld tax, you don't get credit for that inside of a registered account, with the exception that between Canada and the US, because of our close connection between the two countries, there is a recognition between the two countries that where United States equities are held within RRSPs and RIFs and registered pension plans, the payor from the US they are not required to withhold when paying into a Canadian RRSP or RIF as the account. It's more complicated than that, as complicated as that sounds, but it certainly is something to bear in mind. Again, in principle, in a non-registered account, you're going to get credit for what the foreign country withheld before it comes into your hands. Now, one of the things, without characterizing it directly as investment, because we're talking about non-registered investing, one of the things that comes into consideration as you get to the point where you have significant amounts of investment monies, both in registered accounts of their various sorts, as well as in non-registered accounts, you might be looking forward and saying, well, I don't think I'm going to use up everything that I've got over the course of my lifetime. I may very well have a need for insurance, an income replacement need, because I'm a provider to a household. Perhaps I've got an insurance policy in place because I'm estimating out future tax liabilities that would arise upon my death, and so I've got a legitimate need for insurance. Having established the insurance, then insurance policies can be set up so that you can deposit more than what the current annual premium requirement is to keep the policy in force between you and the insurer. And when you pay those amounts in, it's not unlimited, but if you have excess cash and you want to put advance payments of premiums on your life insurance policy, then the amounts that you put in there, subject to the tax rules having a boundary on that, the amounts that you put in there accumulate on a tax-free basis. And when that insurance policy pays out, the amount that the insurance company pays as the face value, plus the amount that's accumulated in there, if there continues to be a balance beyond what the insurance company is directly responsible for, both of those pay out tax-free. So that might be a way, if you have a bona fides insurance need, that might be a way that you might look at the excess money that you have that you don't expect you're going to use during your lifetime, to house some of that within a legitimately set up life insurance policy. Again, conversation with your coach about that. Some of the things that you can do with non-registered investments to be more efficient with your donations is to make a donation, what's called a donation in kind. If you were to make a donation to a charity where the source of the money was an appreciated value of an investment, you would sell off that investment, you would be taxed on that, you would have the capital gains treatment on that, and then the net cash could then be donated to the charity. But if you make a donation in kind, the charity involved has to have a securities account to receive the donation, and you transfer over the security that you have in its current form, in kind, to the charity, so that rather than cashing out and giving them the net, they get the gross amount. It neutralizes the capital gain for you, which means that the charity gets the full amount, gets a larger amount. And likewise, on your side, you get credit for a donation for the gross amount, not the net of tax amount. So the benefit of this is that you're better off by a larger donation credit. The charity is better off by the larger donation. And the only loss, if you want to look at it that way, is that there's less tax being collected by the Canada Revenue Agency. A couple of final points before I wrap it up here. Borrowing to invest is something that some people might look at doing, where rather than taking your dollars and directly putting it into a portfolio, you instead take some kind of a loan and you pay the interest charges over to the lender, and you then invest the loan, which will be obviously larger than the interest charges on the amounts that you're paying over. In order to get a deduction for the amounts that you are paying as interest, the investments must be for non-registered investments. So this doesn't apply for deductibility. It doesn't apply if you borrow money to go into an RSP, for example. So this has to be for non-registered investments that you are borrowing money for. The interest charges, as you pay the interest, are deductible on a current year basis. When you pay those amounts, then the source of the money does matter in terms of the implications for you. If you're going to use a separate checking account, which is a source of paying the interest amounts, then the borrowed money that you put into your investments will continue to grow in value. But if you intend to use the money that you've then put into the investment to then draw amounts out of in order to pay the interest charges, well, as you draw the amounts out, then you're going to be having taxable events on sale of some portion of that, which makes the arithmetic a little bit more complicated. And also, you've got less of your money continuing to be invested. So borrowing to invest is an advanced, sophisticated approach to investing. It works in both ways. It can multiply your returns, or at least increment your returns than might otherwise be the case if you just directly invested your own money alone. But it also can expose you to some very significant risk, in that if things go down, then instead of you just having a reduction in the value of what you put in, you've borrowed to put more amounts in, and when things go down, you could be facing a little bit more exposure to downside risk. What is not deductible for financial interactions is things like financial planning. As critical as it is as a broad base for how it is you manage your money, financial planning is not deductible, and the preparation of income tax returns, which sometimes are done by financial advisors, that's not a deductible expense either for most people, unless all of your income is, or a significant amount of your income is from an investment portfolio, non-registered. Then some portion of your income tax preparation charges might be deductible. Relative to the size of the investment income you might have, the deductibility of the preparation of an income tax return is not a huge consideration anyhow. And then the last item that I want to touch on is in a similar vein of deductibility, is when you are paying amounts to an advisor who is assisting you to invest your money. You can get deductibility for the amounts that you are paying, and the deduction only applies to non-registered investments. So there is no deduction where you are directly paying fees to an advisor on registered accounts, because registered accounts, they are tax sheltered, and the rules do not allow a deduction for advice on tax sheltered accounts. But it does apply where you are buying and selling securities in a non-registered account. One of the things that quite often comes up is, am I better off to pay directly to my advisor or have charges managed within a mutual fund's management expense ratio? And there can be some benefit in some cases to directly paying to advisor rather than the MER inside of a mutual fund. But the arithmetic pretty much shows that in most cases, it's a wash. It doesn't matter whether you pay the advisor or if the mutual fund levies the charge from which the advisor gets compensation. It's a wash in a lot of cases. No deductibility on registered accounts or other services like as I mentioned, similarly to interest charges, no deductibility for financial planning. As important as it is, it's critical to have your baseline for why you're doing your investing, and no deductibility for tax preparation either, where there are fees levied for that. Paul, you're back. I'll let you step in, and I'm going to bring back the agenda so people can see if there are any further questions.
Yeah, and thank you, Doug. I know it's a lot, and again, a reminder that we will be providing a copy of today's presentation. So if you were furiously making notes and might have missed a point or two, that there will be a replay and some of these copies of the slides available. Question we had, and I'm going to rework this a little bit because I apologize. It does involve sort of a bit of a personal situation, but we have an individual who has, I believe, already sold a business under the previous $1 million lifetime capital gain exemption, which has been proposed. There's an increase been proposed in that lifetime capital gain exemption for businesses in the most recent budget. Would you be able to claim that difference next year, presuming in this case that the business has already been sold?
I would say the starting point is no. The transactions happened. You have to talk to your accountant, your lawyer, whether perhaps that there might be room to rescind the transaction, but I certainly would not recommend that. I'm just making a general comment to say that depending on the nature of it, it may be that it hasn't sufficiently gone through, and so perhaps it has not yet happened. But if it's already occurred, then you would be under the rules as they existed. And as you say, Paul, the capital gains exemption is going up to 1.25. Right now, it's just over $1 million, about almost 1.1 million, I think, on the capital gain, and it's going up to 1.25 in a year or two. They're pushing it out. But I don't think that you're likely going to be able to do that, to make a change in that way.
And that's what I assumed. But I would encourage whoever was asking that question, because it was posted as anonymously, which is fine. If you want to talk to a coach at Libra about your specific situation, maybe there's a place direction we can point you in. Generally speaking, if you realized you've missed out on taking advantage of the way of tax treatment to your benefit, are there any general rules that apply to how long ago you can look back at that? So, for example, you forgot to assign a capital loss you may have previously realized against a recent capital gain. Are there any general rules on how long you can go back and re-ask some of those
Yeah,
questions?
I actually, to yourself to go back. The general rule on capital losses is the 3-year carryback on the capital losses. But in terms of you looking back, off the top of my head, I can't recall what the time period is that you can go back and you can refile. The normal reassessment period is 3 years time from the Canada Revenue Agency's perspective, that they can go back and look over things for you. I'm not sure, really not sure off the top of my head, how far back you as the taxpayer, if you realize, oh my gosh, I didn't do X, I really should do that, either for or against. And I'll say, not that anybody wants to know about my personal tax situation, but I came across something when tax preparation software, as I was looking back a few years, it took a deduction that I wasn't entitled to, and I didn't notice it. So I sent a message last year, and it was respect to about 4 years earlier, to the Canada Revenue Agency, and I said, sorry, this thing did this, and so I owe you some money, and they were content to receive. It wasn't a large amount, but they were content to receive that and not charge me interest or penalties.
Well, I'm sure they were content to get your money, but it's nice that, in this case, if it's an honest error and you are the one who discovers it, they do tend to look at that a little more favorably
Actually,
than if they discover things that you're not doing correctly. Yeah.
That is a good point, actually, because, and just for everyone to be aware of, because a lot of people use tax preparation software, you are responsible for what it is that you submit. And in that case, it was the software had done a carryover from year to year, which it should not have done technologically. It shouldn't have done that. And I found it later. But nonetheless, I'm responsible for that. I can point my finger as much as I want over at the software, but the Canada Revenue Agency will go after you. And there have been cases where they said, that's unfortunate, but you filed incorrectly, and so you are going to be subject to either interest or penalties or both for having misfiled in some way.
We have another question, very much aligned to today's topic. So thank you to whoever submitted this one. I have both interest earning investments, so some type of fixed income, presumably GICs and bonds and those kinds of things, and capital gains dividend investments, so stocks that are paying those kind of gains. It would seem that it is best to keep the capital gains and dividend investments outside the RSP, since they would be fully taxed inside the RSP. Well, we know that they're fully taxed when they come out of the RSP, but how would you respond to that as a general rule, to keep the fixed income inside the RSP and the more capital gains and dividends outside of the RSP where possible?
Yeah, I think that as an absolute statement, I don't think that it's something that you should be hard and fast on, to say only have interest as take it to the extremes, only the interest inside and only the capital gains and the dividends outside. But I think you may very well skew proportionately how much will be in those places, because the thing is that when you think about the growth in value inside of an RSP, it is tax sheltered while it's in there. And so if you're going to put a cap on that possibility inside there, then you're missing out on some of the tax sheltering that otherwise would be available to you by having gains without the quote capital gains. Same thing, but the tax treatment on a non-registered account where you get the 1/2 taxation with the variation that we've got to it now. You're conceding on the growth of those registered accounts, and depending on your current asset level and the projected drawdown of all the different accounts, but particularly your registered accounts, it may be that that having gains occurring there inside of that account will in fact be beneficial to you, but nonetheless, that if you have reasonably equal amounts or substantial amounts in non-registered and registered, you will tend to skew the returns that you expect towards capital gains and Canadian dividends happening on your non-registered accounts rather than in your registered accounts.
Okay, thank you. And I realize we're coming up on the hour here, and we may have presenters or people start to drop off. But Doug, if I can indulge you for one more question, if that's all right,
Yeah.
from Dave, could you comment on the theory of withdrawing more from your RSP than you need, assuming that rate is less than the highest tax brackets, in order to deposit that excess to a non-registered account with the end result of reducing taxables payable by the estate someday in the future? So I guess is there a time period where it makes sense to maybe accelerate the RSP, pay the taxes now to get it into a non-registered account for more favorable tax treatment going forward?
Yeah, and you get more flexibility with a non-registered account than you do with your RSP. Once you hit 71, then you're going to have to convert your RSP into a RIF or into a registered annuity, and then you're subject to, well, on the registered annuity, it's just you buy an annuity and it pays out a certain amount. And you don't have any discretion on that. And with a RIF, there's mandatory withdrawals. So if you're in your late 60s and you don't otherwise need the money from your RSP, you may nonetheless decide that you're going to take out more than you need to live on so that you can reduce down the eventual RIF amount and then be subject to less of the mandatory withdrawal. So that's one part of it. And then the specific example you're talking about is at any point, in order not to have more that is going to be subject to deemed disposition on death as you get further into your aging, maybe you take a little bit more out. So that's I'm just recapping what it is that you said. That to say yeah, you could look at doing that. I wouldn't search out for an absolutely correct arithmetic of how it works best unless you already know what day you're going to kick off and die. There really is nothing that will say this is the right way to go about it. I think that as long as you don't put yourself in a really risky position, it's worth looking at, considering, and then you got to make your assumptions of what things going to happen with your life and with your investments, and then it's not a bad idea to think about. I wouldn't say that I would recommend it outright to do something like that, but it's worth having a little bit deeper research on.
Well, I appreciate that, Doug. Thank you. And thank you to everybody who's been able to join us today. We are going to wrap up at this point simply because of the time and recognize that a lot of these questions are difficult and they are personal and they do really talk to the value of financial planning. And I'm really proud of the Libro Wealth Management team we have here. We do have the financial planning acumen inside to deal with both complex personal and business situations. You know, we're going to work in partnership with accountants and lawyers where that's appropriate. And we're going to take the time to look at your situation very personally and try to find that peace of mind step forward for you and your family. Thank you for joining us today. We hope you found the session valuable, and we look forward to having future webinars with you sometime soon. Have a great day.
Thanks.